TDX Stock Research. This report is automated and updated in daily financial and economic data. Shopify, company in the specialty software application commerce subsector. The rating is neutral. Keep in mind that these reports are dynamic and rating could change daily, weekly, or monthly, depending on the changes of the financial conditions of the company and economic data. Shopify in its financial structure shows, in its long-term assets a reinvestment rate about -915%. The return of investment capital ROIC shows a performance of -15%, and if we compare this return with its cost of capital WACC it's -23%, so the company need to improve the cost of financing its assets. The EBITDA give us an idea about the financial liquidity of the company, which is in -$105 million. The productivity of long-term assets in comparison with revenues is 211%. The return of the EBIT after taxes versus the cost of financing 100% of its assets is giving an economic value added EVA near -$487 million in the current report, and the change in this EVA versus last EVA was negative. EBIT should increase in the future, in a rate about 137% if the reinvestment rate performance equal to ROIC, otherwise should performance, at least as is actual operative margin. The EBITDA margin shows us that for each dollar in sales, the company is generating -0.07 cents of dollars in cash. The productivity in working capital shows us that for each dollar in sales, the company has to invest $1.54 in working capital. The company has a growth lever of -0.04, which means that this company is not attractive for a sales growth unless improve the margin EBITDA or the productivity in working capital. The structure between shareholders, equity and liabilities is balanced. The trend in sales last year's has increasing. The trend in EBIT last year's has been decreasing. In a linear scenario, we expect an uptrend behavior for the next years in revenues and neutral for EBIT if maintain the same trend. The sales valuation per share is positive, the relative valuation is in $343 per share. Summarizing, the company has a good financial structure and must improve in its cost of capital. The rating is neutral. This stock could decrease 64% in midterm scenario, if maintain the trend in the net income, and maintain the actual dividend policy based on CAP. The fair price based on WACC should be $58 per share. For this reason the share could very strong. This stock is 34 times the price-book ratio. PE ratio is -825 years, this is because the net losses. Level 1 shows us that dividend policy is on speculation side. Level 2 show us in speculation signal, the net income side. Level 3 show us that the company is neutral building value in relation with its assets per share. An intangibles versus equity relation up to 80% could be a risk factor, in case the company enters in a liquidation status. This relation now is 15%. The three forecast scenarios per share are based on its historical volatilities and show a aleatory return scenario of the portfolio for next 16 months. The rating of this report will change automatically, while the changing of interest rates, risk primes, financial statements, economy data, generating an impact in company's financial structure and sensibility in the valuations. All these in order to be accurate to find investments opportunities.